Good evening, members. I welcome you all for this half-day seminar on the topic Expatriate, Taxation and Foreign Tax Credit Indian Residents. And to deliberate on this subject, we have CA R. Abhishek Murthy sir with us. May I call upon CA Maria Madam to escort the speaker onto dais and welcome you with the floral bouquet. Thank you, madam. I have privilege in introducing CA.R. Abhishek Murthy. CA.R. Abhishek Murthy is a fellow chartered accountant with a strong academic background in commerce and law. With over 9+ years of professional experience, he has advised and represented clients across diverse sectors in matters related to domestic and international taxation, audit, transfer pricing, and litigation. Formerly a partner in NNMS & Co., he brings deep technical knowledge and practical insight in the field of taxation and financial advisory. He is also actively involved in academia as a faculty member at the various institutions, contributing to the development of aspiring chartered accountants. With this brief introduction, I present before you CA.R. Abhishek. Over to you, sir.
Am I audible? Yes. So, expatriate taxation and foreign tax. So this is the topic which we are going to discuss today. And as you know, we have return filing season coming up, and we have expatriates, and the taxation of these expatriates will become even more important. In addition to that, in addition to the compliance aspect which is coming up, we also have a situation where a lot of Indian entities are sending abroad its employees is going abroad, and we are in need of various technical know-how, for example chip manufacturing or any of these areas, and we are getting foreign nationals into India to train our employees or to conduct business. Right? So with this aspect in mind, it is important that we are all aware what are the important aspects related to expatriate taxation. So it's mainly of two sets. One is we will understand the expatriate taxation, that is the salary income. We will also dwell upon other areas which is connected to the expatriate taxation, like maybe FEMA regulations or with respect to income tax returns, right? So we will go into those areas also. Right? So for today's discussion, we will touch upon residential status, then we will understand scope of income tax, then types of employment models we have, and exemptions and carve-outs. So this carve-out also would include discussion on double taxation avoidance agreements. Then taxability of certain components in salary, like travel allowance, what happens to that. Then we will understand withholding, which is the compliance side, everyday compliance side. Certain procedural requirements also will understand what happens when the expatriate comes into India. Should he register someplace else? Should he take a PAN, etc. Then we'll also touch upon slightly on the new tax regime applicable for non-resident individuals specifically. And we'll also see the foreign exchange regulations, how the foreign exchange regulations have to also be considered when we are either planning for sending someone outside or bringing someone into India. Right? So the first aspect is residential status, one of the most important sections in Income Tax Act. Before we go on to the residential status, who is an expat? Right? is it a term which is defined in the Income Tax Act? The answer is no. Expat is a general term what we use, wherein you have a foreign national, they are coming into India, they are not coming in for permanent settlement, but they are coming in for a limited period of time and they have a purpose. And the same holds good on the other side also. We have an Indian employee going outside India, maybe on an on-site project or somewhere, and then he becomes an expat in that country, right? So that is the general understanding of who is expatriate is. Generally, whoever expatriate is coming to India, they will be foreign nationals, they will not be Indian citizens. When you talk about residential status, section 6. So the first thing is, an individual is said to be resident in India in the previous year if the number of days stayed, whether cumulatively or in parts, okay, it amounts to 182 days or more. That's the first provision we need to keep in mind. So if an individual is there, irrespective of his citizenship, he has to be staying in India for 182 days or more. The next clause is alternative to this, or having within 4 years preceding that year, being in India for a period amounting to all 365 days, and is in India for a period amounting to all 60 days or more in that year. So the next clause is alternative to that is 60 days or 365 days in the preceding 4 years. So this would term any individual as resident in India. Okay. Now there are certain exceptions to this rule. The exceptions are basically for Indian citizens either going outside India for employment purpose or boarding a ship. So let's see the exception. So if you are a citizen of India who leaves India in any previous year, okay, this exception is applicable in the year where he leaves, okay. In any previous year as a member of crew of an Indian ship as defined in clause so and so, or for the purpose of employment outside India. Okay. So the year in which you are going out, the provision says that instead of the 60 days, 182 days will be replaced by that. Okay. Then we also have situation where we have Indian nationals who are settled abroad. Now they come to visit India. What happens to them in that case? Okay? So the next exception to this rule is being a citizen of India or a person of Indian origin within the meaning of section so and so, who being outside India comes on a visit to India. So he should have been staying outside on a regular basis, and then he comes to visit India in any previous year, the year of visit. In that case, this 60 will get replaced by 182 days. Okay. Now there is a change in this section, wherein this 182 days will be reduced to 120 days under circumstance. What is that? If his income other than income from foreign sources exceeds 15 lakh rupees during the previous year, then 60 days will be replaced by 120 days. So what would have been replaced to 182 days will get reduced to 120 days. Okay. The logic is basically we don't want people who are visiting India to abuse the provision of 182 days, so that's the reason why they are provided for a reduced time limit of 120 days. And when you are calculating, generally when you are calculating the stay in India, we generally take passport copies. But if you are a person who is traveling through ship, etc., with merchant navy, etc., there we have situation where we have to take something called continuous discharge certificate. Right? So this is with respect to the regular understanding of who is a resident. Now, we also have one more change to the definition of what is a resident. To this resident, government has added now a situation where you have a person who does not have any, who is not treated as resident in any other country. Then government says that if you are a citizen of India, then we will deem you as a resident of India. So this provision says that an individual being citizen of India, having total income other than income from foreign sources exceeding 15 lakh rupees during the previous year, shall be deemed to be resident in India in that previous year if he is not liable to tax in any other country. The most important word is not liable to tax in any other country or territory by reason of his domicile or residence or any other criteria of similar nature. So you are an individual and then you are not treated as a resident of any other country in the previous year, and you are a citizen of India, and income not from foreign sources exceeds 15 lakhs. In that case, you are treated as a resident for the purpose of Indian taxes. Right? So we all know what is the importance of being treated as a resident. So that is the impact of being treated as a resident. Now, what do you mean by liable to tax? Right? When you say liable to tax, should you have paid tax or should you be chargeable to tax? What does the provision say? Section 229A says that liable to tax means in relation to a person and with reference to a country, means that there is an income tax liability on such person under the law of that country, for the time being enforced, and shall include a person who has subsequently been exempted from such liability under the law of that country. Right? So we can imagine three situations out of this. Situation one, so you have an individual. On that individual, a country imposes no taxation on certain class of person. Situation two, a country imposes taxation on all persons but exempts certain class of persons from taxation for all sources of income. Situation 3, a country imposes taxation on all persons but exempts certain class of persons from taxation in respect of specified sources of income. So three possibilities. One, he is not covered at all in the tax provisions. Two, he is covered but has an exemption. 3, he is covered but he does not have exemption as a blanket but with respect to a particular source of income. So in these three possibilities, what do you mean by liable to tax? The second situation and the third situation would amount to liable to tax, but the first situation would not amount to liable to tax, because here section 229A says that shall be included, okay, shall include a person who is subsequently exempted from such liability. So first you have to be added to the tax, you have to be included in the tax provisions, and you can be subsequently excluded from the tax provisions. Okay, so because of that situation, you have situation 2 and situation 3, or here situation B and situation C. These two situations would result in liable to tax, but situation A, where he is not at all included by the country, would be outside the purview of liable to tax. Now this is a deviation from what our understanding of liable to tax was. Okay, so Supreme Court in Azadi Bachao had said that liable to tax means if there is a possibility that a country can tax a person in the future. Okay, in present it might not be, but in the future it can tax it. If that was a if that was a condition, still that would be treated as liable to tax. But now Income Tax Act has been amended. Now it says that you have to be included and exempted. That is okay. But if you are not at all included, I do not worry about what is the future implication of taxation. At present, what is your status? Based on that, I will decide whether you are liable to tax or not. Right? So that is the meaning of liable to tax. So just to summarize, we have a resident. An individual will be treated resident if 182 days or more is staying in India, 2, 60 days or more plus 365 days in previous 4 years. There is exemptions for Indian citizens who is going on voyage and then who is going on employment, and also Indian citizen or a person of Indian origin coming to visit India. So in these 3 cases, we are exemption. 60 days will be replaced with 92 days. Further, one more exemption is in situation where that 182 days would be reduced to 182 days would be reduced to 120 days in case of his income from means not from foreign sources is more than 15 lakhs. Then we also need to understand what is a resident and not ordinary resident. Resident, not ordinary resident would include an individual who has been a non-resident in India in 9 out of 10 previous years. Okay, 9 out of 10 previous year preceding the year in previous one, or has during the 7 previous year preceding that year has been in India for a period or periods amounting all to 729 days or less. Okay, so if these conditions are satisfied, then he is treated as not ordinary resident. Then, if you are a citizen of India or person of Indian origin, to you that 120 days rule is applicable. By default, you will be treated as not ordinary resident. Then, if you are a citizen of India, you are not at all taxed anywhere, not liable to tax anywhere. Then, if you are coming to India, then also you will be treated as a resident and not ordinary resident by default. Okay. Now, why do we have this concept of not ordinary resident? It's mainly to give exemption to individuals, because individuals are very easy to travel. Right? Unlike companies or unlike firms, etc., individuals can easily travel across the world, and their residential status also changes very often. Okay? Because the residential changes very often, countries don't want to tax their global income so easily. So because of that reason, they are provided for not ordinary resident. Okay? So by practice, means in general, what happens is, as soon as the expatriate comes into India, it would take him at least 2 years to 3 years for him to become resident and ordinary resident. So till that 2 years or 3 years, till he becomes a resident and ordinary resident, he can manage, or he can transfer funds, or he can do something outside India which will not impact his Indian income tax return. So that's the main reason why we have this concept of resident and not ordinary resident, so that a person coming into India is not liable for his global taxation immediately. Right? That's the main reason why we have resident and not ordinary resident. Then, so just to summarize our residential status, first condition is 182 days or more. This is mainly for Indian citizens and persons of Indian origin who are visiting India or leaving India during the year for employment. So 182 days or more. Then resident in 2 plus more years out of 10 years, 10 preceding previous years, or stay in India for 730 days or more. If both the conditions are satisfied, then it will become resident and ordinary resident. Otherwise, it will become resident and not ordinary resident. If the income exceeds 15 lakh rupees, that is income from other than foreign sources, then 120 days or more, but less than 182 days, and was 365 days or more in total in the last 4 years, then he will become resident and not ordinary resident. If the person is staying for less than 120 days, or was less than 365 days in total 4 years, then he will become non-resident. Then if it is less than 15 lakh rupees, then it is simple, less than 182 days he is non-resident. For other than Indian citizens and persons of Indian origin, it will be the foreign income, other than foreign income doesn't really matter. 182 days or more if the person is staying in India and then he happens to satisfy the condition of 2 years out of 10 preceding years, or stay in India for 730 days or more than the last 7 years. If both the conditions are satisfied, then it will become resident or ordinary resident. Otherwise, it will become resident and not ordinary resident. Then, if the person is staying for less than 60 days, okay, then automatically he will become non-resident. Okay. So these are the broad overview of residential status from income tax perspective. Now, some important aspects which you need to keep in mind when we are calculating or giving this exemption of especially changing 60 days with 182 days is, as you know, law mandates that if you are going outside India for employment purpose, then the 60 days will be replaced with 182 days. Now, should you be employed before you go, or can you still be employed before you leave? Okay, so we have case laws which say that you need not be unemployed before you leave India. Okay, you can still be employed and then you can give up your employment and go, or you can still change your employment. That is also considered as pursuing going outside India for employment purpose. Okay, so that is the first thing. Then deputation. If Indian staff are going outside India on deputation purpose, whether deputation results in employment, okay, the answer is no. Okay, you are continuing your employment. Okay, you are an employee, let's say for Infosys or TCS, whatever, and you have an offsite project. So you have an on-site project. You need to go outside India. So you don't give up your employment. You just you go on a on-site this one. So are you trying to say that here this exemption means this exception will not apply to you? Answer is no. Even deputation, okay, even deputation for that matter, also is considered as going outside India on employment basis. Okay. So next, now you are staying in India, and then let's say you want to visit some country. Now, whether foreign visits also will be considered as leaving India for employment? Answer is no. So, foreign tours, all these things should not result in application of this exception we have to the 60 days rule. And when you say employment, does it include consultants or does it include business people conducting business? Answer is yes. So it need not be that you are a salaried employee. Even consultants can go out of India and still take the exception of replacing 60 days with 182 days. Okay. Same rule applies even for business person. Let's say he wants to set up some business outside India, he wants to set up a branch outside India, he wants to build contacts. So he travels for a pretty long period of time on the purpose of setting up business outside India. That person also is eligible for this exemption, wherein the 60 days will get replaced by 182 days. Then, let's say you are already employed, and once you are employed, you resign your job and come back. Now, when you come back, does the exception of visit to India is applicable to you? The answer is no. When you say visit to India, you have to be already means you have to have permanent stay outside, and then you have to visit India on a temporary purpose. You have to visit India for a temporary purpose. So if you are coming after resigning, then the 60 days criteria will not be replaced by 182 days. Okay, so that is something which we need to keep in mind. Okay, return to India after resigning from job cannot be said to be visit to India. Then, if we have a situation where, so there is a person who has come to India on employment, he is staying in India, and then he is going outside to visit his family and he is coming back. He is going outside to visit his family and he is coming back. Does he have any exceptions? The answer is no. He does not have any exceptions in this case. Okay. Then next situation is, you have an employee, he is employed outside, he comes back to India, and then let's say he rejoins another subsidiary. So for example, he is working for TCS, he has got deputed, he had gone out for let's say working for US subsidiary, he comes back after the deputation, and then again goes back, let's say to Cyprus for one more on-site project. So now the person coming back and then again going out, can he claim the exemption of going outside India for employment again? Okay, the answer is no. Rejoining for the purpose of employment does not result in change of 60 days with 182 days. Right? That cannot be used. So these are some of the case laws which are important with respect to claiming of your exemptions under claiming of exceptions with respect to 60 days. Then when you're calculating stay in India, should you include the day of going out and should you include the day of coming in? Should you include both the days? Or should you exclude both the days? Or should you include only one day and exclude the other day? How do we do it? Right. So generally, our OECD commentary on this says that the day of departure as well as the day of arrival both have to be treated as stay in India as per the OECD guidelines. However, we have various case laws in income tax which says that the day of going out, for the purpose of calculating stay in India, you have to exclude that, right? So, for conservative purposes, include both. But if you happen to get in a situation where you have just one day, half day, all these coming into picture, then you can use these case laws to help you with the supporting your advice. Right? So we have case laws which says that the day of arrival is to be excluded for calculating the number of days. Then let's say we have a situation where there is a person. This person has gone out of India for employment purpose, and the next year he comes to India for visit. Okay, so because he is going out on employment purpose, he has the exemption. Has the exception. And then when he is coming back to India on visit purpose, the next year, there also he has this exception applicable to him. But after he visits, he goes back, he resigns his job, and then he comes back. So we have a situation where in the same year we have visiting India, and also we have a situation where that person is coming back to India on a permanent basis. So both are there in the same year. Now, how do we interpret? Should we change 60 to 182 days? Or should we interpret or should we retain 60 days and deny the fact that because he's come back to India in the same financial year, in the same previous year, should we deny him? Okay, so we have very interesting case now here, Manoj Kumar Reddy. In this situation, what happened was the assessee left for US on 1/2/2004. Okay, preceding year, previous year. In the current, that is a year in which the case law is based on. In April 2004 to January 2005, he was there in USA. During this period, that when he was in USA, that is April 2004 to January 2005, he visited India from 18/8/2004 to 6/9/2004. Okay, so he is visiting India. So because he is visiting, 60 days should be replaced by 182 days. But in the same year, okay, on 31/1/2005, the assessee came back to India for permanent settlement. He came back to India for permanent settlement. Okay, so how do we calculate the number of days stayed in India? Okay, we can calculate number of days. I'm not saying that we can't, but what I'm saying is, which should we give him this exception of 60 days and replace it with 92 days, or should we retain 60 days? If we retain 60 days, then what happens is he will become resident in India and probably resident and not a resident. If we replace 60 days with 182 days, then he will become resident and he will become non-resident in this case. Okay? So the courts in this case held that the period between the number of days, okay, between his visit, okay, it should be excluded for the purpose of calculation. It should be excluded for the purpose of calculation of staying in India. So the between 18/8/2004 to 6/9/2004, anyway, even though he is visited India, we should treat that, we should not consider that for the purpose of calculating number of days stayed in India. Okay, so that's the basically the gist of case law. So number of days stayed in India under certain circumstances can be very interesting in this case. Now, is there a possibility that because individuals are traveling, can there be situation where a person can be resident in one country and he can also be resident in the other country where he is traveling to? Answer is yes, right? Because we have 182 days as a condition in our income tax provision. The other country can also have similar condition. Because of that, or because they have financial year which is different from our previous year, there could be possibility that a person can be resident in two countries. He can become resident in India and he can become resident outside India, wherever he is traveling. Now, what is the problem of a person becoming resident in two countries? Right? The problem here is global income gets taxed. Okay? Who gets the right to tax global income? Does India get the right to tax global income, or wherever he is traveling, does that country get the right to tax global income? Right? That is the most important aspect of residential status. Now, to solve this, DTAA has something called a tiebreaker. In every DTAA, we have something called tiebreaker. Okay? So, let's understand what happens under DTAA and how this residential status problem can be resolved. So, most of DTAAs do not prescribe residential status. What they do, they only break the tie. The residential status is always prescribed by the domestic law of the country, means where the person is traveling, or if it is from India, so India. So the residential status will be always driven by the domestic provisions of the country. DTAA will only break the tie wherever there is a overlap of residential status. How do we resolve this problem? there is a hierarchical tiebreaker test which has to be applied. If through the tiebreaker you cannot solve the dual residential issue, then you need to approach the tax authorities under mutual agreement procedure to resolve the matter. In case a person is traveling to a country where there is no double taxation avoidance agreement, then income would become double taxed. So for example, let's say I am traveling to some part in Africa where we don't have DAA, and then I have income there, and I happen to become resident in that country because of the domestic provisions, and then I have a savings account in India, and then there is an interest, let's say 50,000 interest is there in India. So India also I am a resident because of number of days stayed, etc. So I have to pay tax on that African country income in India, and then also the fixed deposit interest in India. In that African country, when I go there, I become resident in that country because of their domestic law. We don't have double taxation avoidance agreement. We end up there, so I have to go there. I have to pay tax of that country, plus I have to include the interest whatever I earned in my savings bank account in India and pay tax there. So that is the impact of becoming resident in two different countries in the same previous year. So you happen to become liable to tax on your global income in two different countries. Now, what is the solution for this when you don't have DAA? We have section 91 which says that you have foreign tax rate you can claim in such situation, right? You have to in India, whatever the taxes you have paid on your income in Africa, whatever you have to take credit of that. And in Africa, when you file the return, you have to, whatever taxes you are paying in India, you have to take credit of that with respect to the taxes. So that is how you resolve where you don't have double taxation avoidance agreement. But wherever we have a lot of trade, we always have double taxation avoidance agreement. So we can apply the double taxation avoidance agreement and then we can break the tie. When you are breaking the tie, should you consider the employer or you should worry about the employee? You should always think it from the employee perspective because that is a person who is earning the income, right? How do you break the tie in case of DDAA? Step 1 is, first you need to make sure that you are resident of either one or resident of both contracting countries. Okay, you can be resident of both contracting countries or you have to be resident of one. So that is point number 1. Only if you are a resident of one of the countries, you can access that DAA. If you are not resident of that country, you cannot access the DDAA of that country. Point number 1. Point number 2 is, under the domestic law, you have become a resident. Let's take example Germany. Okay, I have become resident in Germany. I have become resident in India. They also have something 182 days. I also have something 182. India also has 182 days. Because of that, let's say we will become resident in both the countries. Now, step 1 is permanent home. Go to the DAA and then first thing is permanent home. So what do you mean by permanent home? Do you mean that you need to own house? The answer is no. Permanent home means you need to have access to a place on a permanent basis. It may be a rented place, it can be a hotel accommodation, okay, it can be Airbnb, but you need to have access to the place on a permanent basis. So, step 1 is, where do you have permanent home? Do you have permanent home in India or do you have permanent home in Germany? Right? That's the first thing. Let's assume you have permanent home in India. Then the tie will be broken. You will become a resident of India. Okay, you will become resident of India. Let's say you have permanent home in both the countries. You have a home in Germany also and you have permanent home in India also. Then what happens? Then we go to the next one. Okay, it has to be, means we have to apply the rule in a chronological, I mean in a sequential order, we can't jump to something else. So the next thing what we need to do is center of vital interest. Center of vital interest means where your personal and economic relations are closer. Okay, you have a firm in India, so firm in India is an economic relation. So you have family in Germany. Family in Germany is a personal relation. Right? So where is your economic and personal relationships closer? That is where the center of vital interest would fall to. Okay. Most of the cases we can determine where the center of vital interest is. So, but there may be some situations where it is indeterminate. We can determine the center of vital interest. Then what happens? Okay. So then we go to habitual abode. Okay. So we have permanent home in both the countries, and then center of vital interest unable to determine. These two conditions are satisfied. Come to habitual abode. What do you mean by habitual abode? So when you get vacation, where do you go off? Okay, you go back to your home, or you go back to your native place, whatever, right? Similarly, where do you generally reside? It decides the habitual abode. Okay, generally on the number of days stayed, etc. There you can decide the habitual abode. Now let's assume even based on habitual abode, you are unable to determine where the residential status falls. Then you have to go with nationality, that is citizenship. You have to go with nationality. Where are you? Nationally. Now let's assume even that also cannot help you resolve the matter. Then you go for mutual agreement procedure, wherein you have to write to the map authority and request for mediation with the other country and resolve the matter of this dual residential. Okay, so and this tiebreaker is this tiebreaker, whatever is going to DAA, it is something which the DAA, most of the DAAs have. Okay, there are some exceptions where this tiebreaker is not there, but most of the DAAs have this. The reason is because individuals can keep traveling between countries, the number of days stayed, etc. can get varied very easily. That's the reason why government, the DAA itself has provision for this. Now, so we understand how you break the tie. Okay, when you have an individual who is becoming resident in two different countries, we now understand how you break the tie. Now, the second set of problems what we can come across in double residential cases is overlap, okay, or something called as split residency. Okay, so let's take an example and understand this. So, for example, in one calendar year, an individual is resident of state A. Under the state tax laws from 1st January to 31st March, then moves to state B. Because the individual resides in state B for more than 183 days, the individual is treated by the tax laws of state B as state B resident for the entire year. Okay, so if you can observe here, from 1st January to 31st March, you are resident of one place, and then in case of the state B, there also you are resident for a similar tax period. So how do you resolve this matter, right? So what the OECD commentary, etc., all these commentaries say is whenever you have dual residentialship, based on when the income was accruing, okay, based on when the income was accruing or arising, we need to decide the country which will have control over the resident have taxing rights over the individual. Okay, so by applying the split residency, what happens is from 1st January to 31st March, the individual was a resident of state A. Therefore, both state A and state B should treat the individual as state A resident for that period. And thereafter, from 1st April to 31st December, he will become a resident of state B. Right? So, there is a possibility that in the same financial year, okay, in the same financial year, a person can become resident in two places, and the countries can have taxing rights in based on the time period and not based on the whole financial year. Okay? So what do we understand from resident? So because the number of days spent in a country is exceeding certain days, we decide that he is a resident for the whole year. That's what our general understanding is. But when it comes to expatriates, there is a possibility that the year in which he is leaving India or the year in which he is coming back to India, there is a possibility that that person can become resident in two places. Right? Now, if he becomes resident in two places, then what happens is, if it is in the if the dual residentship is applying in the same period, there is a possibility that your tiebreaker can also not help. Okay? So that's the reason why you have situation where we have split residency situation. Now, we'll take an example in case of split residency. So this is case of Raman Chopra. So ITIT decision in the case of Raman Chopra versus DCIT, the assessee came to India in July 2010. He was a resident of USA as per the tax laws and as per the DDAA from April to June 2010. The assessee was also a resident and ordinary resident for financial year 2011. Okay. The ITT held that applying the tiebreaker test due to dual residency, it has broken the residentship into two parts. The first part is from April to June, he is a resident of USA. From July onwards, he will become a resident in India. He will become resident in India. Okay. So this is called as a split residency situation. This is called as a split residency situation, wherein in the same year, based on time, okay, based on time from X date to X date, he will become resident in one place, and then later on he will become resident of the other country. Okay. So that is one of the important aspects which we need to keep in mind. Then there are case laws also to say that, let's say you are staying in a country and you don't want to stay, but because of certain practical reasons, let's say passport was missing or you lost the passport or someone stole it, for whatever reason you could not travel. Okay, you have no intention to stay, but because of X or Y reason you could not travel outside. Now, should you consider the number of days stayed in India for that reason for the calculations? Answer is possibly no, because there are case laws which say that if you are staying in India for involuntary reasons, then you could exclude that for the purpose of residential calculation. Okay, so involuntary stay of assessee in India caused by unauthorized impounding of passport must be excluded for determining his residential status. Okay, so that is also possible. And even CBDT, because during the COVID period, they also had a provision which said that the number of stay between I think 23rd March to so and so date, 31st March, should be excluded in case you had travel plans and then you were unable to travel, right? So we also had that exclusion, which was provided by CBPT. Okay. So these are some of the important aspects with respect to residential status. So we have understood what is resident as per the Act. Then we have understood what happens in case of a dual residentialship. Then we have understood what happens in case of a split residentialship. And then we have also seen certain case laws which are which provide more explanation on the exceptions what we have to the residential status. Now, once we have understood the residential status, the next thing what we need to understand, especially for expatriate taxation, is scope of income. Scope of income is very important because what generally happens is whenever there is an income which is being received by some person, by answering where does it accrue or where is it received or where does it deem to accrue or arise, we will be able to resolve a lot of issues with respect to taxation, right? For example, there is a Indian, let's say there is a Indian employee. He has traveled abroad on on-site job. Let's say he stayed there for maybe 4 years or something. And during his stay, it was mandated that he deposit certain money to the state pension fund or something of that country. Then during his stay there, he deposits that money. After some time, he comes back to India. Then the pension fund in that country deems that that person has already left. So after some period of time, lock-in period, they transfer that money back to that individual. So 2-3 years later, when he comes back to India, he receives some money to his bank account in India from that pension fund. Now, who should get the right to tax? Should India tax it, or should let's say he's coming from USA should tax it? So the understanding of scope of income would help us in splitting this issue. Okay. So in this same example, because the pension, whatever was due to him, accrued to him when he was being employed in USA, it is not taxable on receipt even though it was received in India. So we have case laws to support this, but the fact that it accrued outside India in this case played a very important or vital role in deciding where the taxation or who gets the right to tax, right? Without even going into detail. So that is the importance of scope of taxation. Where income accrued or where is it received is a very important aspect with respect to taxation. So when you understand scope of taxation, the first thing is income received in India. So if you are receiving income in India, that is the first instance of receipt, then it is taxable in case of resident, ordinary resident, not ordinary resident, and non-resident. If income is deemed to be received in India, that is transfer from PF, unrecognized PF, all these things, it is treated as taxed in all the 3 cases. If income accrues or arises in India, what do you mean by accrue or arise? Does accrue or arise means due? Answer is no. Accrue means it becomes vested in your case. It need not be payable to you, but it becomes vested. Okay, you don't have the right to enforce payment in this case, but you have a right to receive in this case. Okay, so accrue refers to right to receive income, whereas due refers to right to enforce payment of the same. Okay? So if income accrues or arises in India, then it is taxed in all the 3 cases. If income is deemed to accrue or arise in India, so accrual or arise is happening outside India. but you are forcing through certain nexus, maybe business connection or property in India, right? You're forcing the income to accrue in India. That's called deemed to accrue under Section 9. Then it is taxed in all the three cases. Then income accrues or arises outside India, and it is not deemed to accrue in India. Then it is taxed only in the case of resident and ordinary resident. Not ordinary resident is not taxed. Non-resident also it is not taxed. Then income or accrues arises outside India from a business or profession which is controlled or set up in India. Then it is taxed in the case of resident and not ordinary, and resident and not ordinary. Both the cases it is taxed, but in case of non-resident it is not taxed. Income from anything other than above, it is taxed in the case of resident and ordinary resident, and not taxed in the case of not ordinary. So this is how the scheme of taxation is there under Section 5. When it comes to expatriates, which is an important section for us, we need to understand Section 5, that is on receipt basis, accrual, right? We need to be very careful with that. And also we have Section 912, which basically is applicable mainly for non-residents or not ordinary residents. What does Section 912 say? Salary earned in India is taxable. That is, if it is payable for services rendered in India and also for the rest or leave period, which is both preceded and succeeded by service rendered in India and forms part of the service contract of the employer. Right? So, under Section 912, there will be situation that, so there is an employee, okay, he is, let's say, a German company, Bosch, they have an employee. This person is getting a salary in Germany for, let's say, 6 to 1 year. They debut to India, and then during his deputation, let's say they pay him some salary. The salary is credited to his German bank account. It is not received in India, it is credited to German bank account. Okay, so by virtue of Section 912, okay, by virtue of Section 912, they say that salary is earned in India and it will become taxable, because the salary which is being paid is for the service rendered in India. It will become taxed. It will get taxed under Section 5 itself because it is accruing to him because of his service in India. Now, he has come to India, 1 year he has worked. During this time, he has accumulated certain earned leaves. Then, this earned leave, whatever he has accumulated, he goes outside India, he spends time for his leave, and then during that period of time also, he is getting salary. Now, where is the income accruing? Does it income accruing? Let's say he travels to Thailand and then he spends time for his earned leaves. Now, where is it accruing? Is the income paid to him during the leave period, which he is not residing in India? Is it accruing in India? It is accruing outside India. Okay, it is accruing outside India, but it has been deemed to accrue in India because that money, the earned leave, he was eligible because of his service rendered in India. Because of his service rendered in India, right? So, when a person is coming to India, because of the taxation doesn't get triggered only because of Section 912. You should also consider Section 5 also into perspective, because Section 5 taxes income based on accrual, and for the service he is rendered in India, it will be Section 5. But during that period, let's say something else he is earning and then he's paid out he is using it somewhere else, Section 912 will come into picture and then say that is also taxable in India. So, for an expatriate, two sections, section 5 and section 912 will become important. Then when will it be taxed? Okay, salaries, income from salaries are taxable on due or receipt basis, whichever is earlier. Okay, so due means, let's say every day I am working, it is becoming due, so it is becoming accrued, and at the end of the month it is becoming due. Then I am taking something in advance, let's say I am taking employee advance, then it is paid in advance. And the other possibilities are, every month, let's say I am contributing to Provident Fund, okay, and then it is paid to him after maybe 1 year or 2 years, okay, when and it is paid to him after he's gone out of India. Then what happens? Because every month it accrues, it is still taxable in India. So salary due from an employer or former employer, advance salary when paid, even if it is not due, arrears of salary paid by or on behalf of current employer or former employer, if not already taxed. Okay. Further, it is also taxed on due or receipt basis, whichever is earlier. So you need to keep in mind all these aspects when it comes to taxation of salary. Okay. Then for non-residents, not ordinary residents, let's say they are receiving certain funds. Okay, they are receiving certain funds during their employment in India. Okay, but this got accrued to them when they were not serving in India, but they were serving outside India. Is it taxable or not? Is the question. Okay, salary is due outside, but it is paid in India. Okay, we may have lot of these cases wherein, let's say there is an employee, he is working for a German company, he gets deputed to India, he gets ESOP. Now when he gets ESOP in the, let's say 3 years he is Germany, 2 years he is there in India, he gets the 5 years for ESOP vestation, completes in year 5, he gets ESOP. Who has the right to tax? Does India have the right to tax because ESOP is given in this year, or does Germany have the right to tax because 3 years for which he is eligible for, he has served it in Germany? Who has the right to tax? Right? So to answer this question, we need to understand where is the point of accrual and when is the point of receipt. So just because it is received in India in this year, that doesn't mean that India has the complete right to tax this ESOP. Okay, it will be bifurcated in the ratio of 3:2. 3 parts it will be taxed by Germany, 2 parts it will be taxed by India based on section 5. So that's what the majority of the case law basically talks about. Even though there are some case laws which say that it has to be taxable on receipt basis, but majority it is understood that it has to be taxable on due basis. Okay. So when it is paid, especially for salary, when it is paid is not material, it is when it is due, which is very important. Okay. Now there are some exceptions to this rule. Okay, there are some exceptions to this rule. So the exceptions are, especially for we have notification also to the right? Salary received in Indian NRI account for services rendered outside India, place of accrual and receipt held to be outside India, hence it is not taxable. Right? So we have case laws wherein even though the receipt is initially there in India, then here the case laws are saying that it is not taxable in India because the due, where it was outside. Only for practical purpose, it was paid to his NRE bank account. That doesn't mean that it is taxable in India. Right? So that's the reason why due, receipt, section 5 and section 912 plays a very important role. Okay, so we'll take a break and then we'll come back and we'll see different models of employment. The first concept what we have is called secondment. Okay, so what do you mean by secondment? Under secondment, there is an employee, let's say a German employee, and they have let's say a subsidiary, or they have a branch, or they have some related company or someone in India. They have to send, they need some technical resources or something of that sort. So they send this employee, okay, they second this person from Germany to India. Second means they transfer so the German company stops becoming the employer and the Indian company will start becoming the employer. So this is a case of secondment. Now there are two aspects to secondment. One is practically people do secondment agreement and they transfer the employees, but in what do you say, substance, the person still will be reporting to the German company. Okay, now that is a practical problem what we have. In that case, should we consider it as a secondment? Answer is no. When you say secondment, the complete control over the employee has to be transferred to the Indian entity. That is called as a pure secondment. Okay? What do you mean by control? Can you fire? Can you hire him? Can you give him a raise? Can you say that I don't like can you give review about that person? Can you shift him to a different job profile? You have those rights. That is, I'm to say the Indian company. Does Indian company have those rights? If the Indian company has or exercises these sort of control on the employee coming from Germany, then the employee is purely secondment. If the Indian entity does not have such control over the employee, even though the agreement is called secondment, it is technically not a secondment. It is something called as, we call it as deputation. Okay, so that is a major difference between secondment and deputation. Okay, so in secondment, the expatriate employee effectively becomes an employee of the Indian entity. His salary costs are borne by Indian entity, who is responsible for all the acts, omissions of the employee. Indian employer reimburses salary to the foreign employee. So he becomes employee of India, but for several reasons, that person would say that I don't like to receive money in India, I like to get credited to my bank account in, let's say, Germany. So the money what has to be paid to that employee will be transferred to the holding company as a reimbursement, and that person, that holding company would pay the money to the German person's bank account. So that is how the transaction basically happens. Now, in a pure secondment, what are the other practical challenges? Now, first is the money received by German person. Where it will be received? It will be received in Germany, in his bank account in Germany, paid by the German holding company, but he is working solely for the Indian entity. Okay, that is a practical situation. Where is it taxable? Is it taxable in India or is it taxable in Germany? Okay, even though it is received in Germany, the place of accrual for that income is India, so it would become taxable in India, section 5 as well as section 9(1). Based on that, it will be taxable. Then TDS. who has to do TDS? Should the German employer do TDS or the Indian employer do TDS? It will be the responsibility of the person who is the economic employer. Economic employer is Indian entity, so Indian entity has to do the TDS. Even though money is not directly paid by the Indian entity to the German person, it will be transferred to the head office. In turn, that happens, but TDS responsibility is on the Indian company. Now, the money will be paid by Indian entity to the German company. German company will raise an invoice for reimbursement. Reimbursement will be equal to the salary of the German employee, right? Should we deduct TDS when we make remittance to German entity? We have already deducted TDS and deposited with government on the salary payable to the German employee. Now the question here is, should we deposit or deduct TDS when we make a remittance to the German entity? Because Indian entity is an economic employer, German entity is only for the purpose of convenience doing this transaction. There is no income arising to the German entity. TDS would not be required to be deducted. TDS would not be required to be deducted on the reimbursement invoice raised by the German entity to Indian entity. Then, risk of permanent establishment. Does making payment or having a person seconded to India, does it create permanent establishment risk to the German company? The answer is no, because the real and economic employer of the German employee is Indian entity, because Indian entity is the real economic employer. In this case, it would not create permanent establishment risk for the German entity. Okay, so that is something which we need to do. Then, what happens under GST? Should we pay GST on reverse charge mechanism when we make payment to the German entity for doing the reimbursement transaction? If it's a pure reimbursement, there is no necessity. If it's a pure reimbursement, there is no necessity to pay GST under reverse charge mechanism. Then, should this transaction be reported in transfer pricing report? The answer is yes. Okay, this is an international transaction, and even though it is a reimbursement, it doesn't involve any income for the foreign entity. It has to be reported in the transfer pricing documentation. It has to be benchmarked. Okay, because it's cost, it is cost to cost benchmarking. There is no problem, but it has to be reported in the form 3C. Right? So this is with respect to secondment, and it is a pure secondment. In practice, what we see is, even though the agreement would say secondment, the German employer in this example can control. So in that case, we cannot say it is a pure secondment, but all these things applies to a pure secondment. Okay. Next is deputation. In deputation, what happens? In deputation, you have a German company, you have a German employee. That person doesn't lose his employment status with the German entity. He will be deputed to the Indian company. So the real and economic employer in this case is German entity. It is not Indian entity. Who has the right to hire, who has the right to fire, who can give increment, who can criticize, who is responsible for that person's errors, etc. Everything will be the German entity in this situation. In secondment, it is an Indian entity. In deputation, it is the German entity. Okay. Now, in this case, whenever you do a deputation, the economic employer is German company. is the income for the employee, is it chargeable to tax in India? The salary whatever he is receiving in Germany from the German company, is it chargeable to tax in India? Answer is yes. Because of 912 and section 5, it will become taxable in India. But who has to deduct TDS? In this case, the German company has to deduct TDS because German company is the real economic employer. Okay, that's point number. Does it create permanent establishment risk for the German company? The answer is yes. It will create permanent establishment risk for the German company because it is his employee sitting in India rendering services on behalf of the non-resident. That would create permanent establishment risk for the company. In the earlier circumstance, it was German individual working for an Indian company. But in this case, the German individual who is working for a German company in India. So that's a difference as compared to secondment and deputation. Okay, so there is a risk of creating permanent establishment for the German company. Next, should we deduct TDS when we make a reimbursement to German company? The answer is yes. When Indian company is making remittance to the German entity, we are not paying salary. We are basically paying fee for technical services to the German company who have deputed a person to render technical knowledge. So because of that, that would become fee for technical services. It would get covered under DDAA or 115 and 20% plus. This withholding is required. Should we pay GST on reverse charge? Answer is yes. We have to pay GST on reverse charge because here for us, it is not the employee who is rendering services, it is a foreign company which is rendering services to us. So reverse charge might be applicable in this case. Transfer pricing is still applicable in this case also. Both the cases we need to report. But when we report here, we have to report it as a purchase of services or payment towards services as compared to the first circumstance where you would report reimbursement of cost. That's a difference. Here you have to do benchmarking, you have to find comparables for this. Whereas in that case, you don't need to do benchmarking. You can justify it by saying it is cost. Okay? So that is the main difference between deputation versus secondment. Then we have payroll transfer. Under payroll transfer, what happens here is that person will resign in Germany and he will take up employment in Indian company. So everything like how Indian employees will, if they resign, gratuity, all those things is there. That is everything is settled, and that person basically shifts to Indian payroll. In this case, it is very much similar to there is no question of what do you say? There is no point of means he stops having any association with this foreign entity. So things are much simpler. It is on par with any other expatriate, means hiring any other expatriate. Okay. Then dual employment. So in case of dual employment, he becomes an employee in India, he becomes an employee in foreign entity. Both the places he is an employee. In this case, it would go back to deputation. It would go back. The problems will be similar to a deputation situation in this case. Okay. Then, when you have expatriate, two possibilities exist. One is you have expatriate employee of an Indian company going out, and then you have an expatriate employee coming to India. So when you have an Indian person going out of India, remuneration whatever is payable to him will get covered under section 5, and based on accrual arise or received in India, it is taxable. The chances that he will become non-resident is very high as soon as he goes outside India. So for us, it is not a big issue for us because he becomes a non-resident. But when a person is coming into India, then Section 912 will become applicable. Section 912 will become applicable. Whatever the salary which is paid to him during service rendered in India, that will become taxable in India. That will become taxable in India. Okay. Let's take this example wherein Mr. A, an Indian citizen, is an employee of I company and he is sent to I company subsidiary in country X. Okay, so Indian going outside. F company on secondment basis. He renders his services in country X. Taxability of Mr. A's income would be as follows. Salary received in country X for services rendered in country X. If he is a resident and ordinary resident, it is taxable in India. If it is not ordinary resident, not taxable, non-resident, not taxable. Salary is received in country X for services rendered in India. For resident and ordinary resident, it is taxable. If it is not ordinary resident, it is taxable. Non-resident, it is taxable. He is an employee of foreign company, but he is rendering services in India and he is working for, his salary is received in foreign place. Then salary is received in India for services rendered in country X and India. Services in country X as well as India, both the places. Resident or non-resident, if he was a resident and not a resident, it is taxable in India. If he is a resident and not ordinary resident, it is still taxable. Resident and if he is a non-resident, it is still taxable. The reason is for taxation is he has received in India for salaries for services rendered in country X. He is received in India. Okay. There are some exceptions to this rule where it accrues, etc., etc. So based on that it can change, but generally because he is receiving in India, it will become taxable. Then, what happens to Mr. A's salary pertaining to employment period in country X? That is, salary is accrued outside India, is then remitted to India subsequently. Okay, so he is working, let's say in Indonesia, and then when he is staying in Indonesia, certain money has accrued to him. After he comes back, it is paid to him. Where will it be taxed? It will be taxed in Indonesia, it will not be taxed in India, so it goes outside the purview of taxation. Then, payment received by assessee who is not ordinary resident during relevant year towards retirement benefit, severance, vacation, engagement from erstwhile employer in USA on termination of employment in USA would not come within the purview of section 912 because it has become due outside India, only it is paid later to India, taxation will not get triggered in India. Then, whenever we are doing secondment of employees from Indian entity abroad, some of the provisions which we need to keep in mind is we are seconding Indian people abroad. They, when you say second, they are going into the payroll of that entity, and then only for the purpose of convenience, the money is being paid to his Indian bank account. Now, in this case, we need to cross-charge or we need to invoice the foreign entity, which is the economic employer in this case, and then we need to repatriate the money to India, and we need to claim the exemption for export of services. We need to claim the exemption for export of services in this case. Okay. In case that person is paid outside India, then it is a practical challenge in this case. It's a practical challenge. So because for export of services, what happens is you need to repatriate the money. If you don't repatriate, you can't take the exemptions under GST. Right? You need to collect the GST. So that would be one of the practical challenge with respect to Indian employee being seconded. Okay. So that is one thing which you need to keep in mind. Then we have certain sections in Income Tax Act wherein if the employee is coming in India for a very short period of time, let's say there is an equipment which we have purchased from let's say Korea. That equipment has to be installed and it has to be brought online for production sake. To install this equipment, you need technical people. So I asked the Korean company to send some person to India. Korean person comes to India, he stays in India for 20-25 days and then he does the installation. Now the person who is staying in India and doing the installation, that is a Korean person, for him salary whatever has been paid in Korea for that person will become taxable in India because section 912 rendered in India. Do we want to tax such small periods of stay? Do we want to tax such small period of stay? Is the question. Government says no, I don't want to tax it. So what does the government do? Government has brought in section 10(6) which gives certain exemptions from taxation. So under 912 it is taxable, but because of 10(6) it will go outside the purview of taxation through exemption. What are the conditions? This person is Korean person, please keep that in mind. His stay in India is less than 90 days. Okay, it's less than equal to 90 days in the year previously. He is not a citizen of India. He is not a citizen of India. His employer is foreign enterprise and it does not have presence, it doesn't have business connection in India, not engaged in trade or business in India. So it is selling everything abroad, only for fixing it, it is that person is coming into India, but generally they don't have any business connection in India. If all these conditions are satisfied, then and one more condition is there, and the salary whatever is being paid by the Korean company to the Korean individual has not been claimed as deduction by the Korean company under Indian Income Tax Act. Okay, it will be claimed as deduction under Korean law. That is not our concern. Here the law is saying that Indian company should not have claimed it as deduction under the Indian Income Tax Act. Okay, if they don't have business connection, automatically they would not have claimed a deduction, so that is not a problem. So if all these three conditions are satisfied, it is 90 days, citizen, foreign enterprise, not engaged in business and does not claim expenditure of deduction in India. If all these conditions are satisfied, then in his hands, whatever the salary is paid, that will be exempt. In his hands, whatever the salary is paid, that will be exempt from taxation in India. Okay, so that is under section 916. Do we have any benefits under DAA? The answer is yes. Under DAA, we have Article 50, which also has similar benefits. Under DAA, the conditions are instead of 90 days, it is 183 days. So the condition says that the person should stay in India for less than 183 days for 12 months period, commencing or concluding in the year. The employee should be resident of treaty partner country. They don't talk about citizen, here they talk about resident. So in our example, this Korean individual coming to India should be resident of Korea, and here it is tax residency, it is not citizenship. The employer has to be foreign resident. The employer in our example is a Korean company, it has to be non-resident for Indian tax law. And the remuneration is paid by or on behalf of non-resident employer, and it is not borne by the permanent establishment in India. So the salary which is paid by the Korean entity to the Korean individual should not be claimed as deduction in India. Okay. So if these conditions are satisfied, then the country, that is India, cannot have the right to tax under DDAA. Right? So we have section 10.6 which talks about similar exemption, but the conditions are more stringent and the conditions are narrower, whereas under DDAA the conditions are more flexible and they are much more wider. So DDAA provisions are much more beneficial in this case. Who needs to apply these provisions? It has to be applied by the employee. Okay, he has to use the DAA provision and he has to claim this benefit. It is not to be, because income is accruing or arising to the employee, he has to apply these benefits. It will not be the foreign company. Do we have any other exemptions under section 10? The answer is yes. We have different sections. 10.6.2 which will exempt salary for people working in embassies, etc. Then 10.6, 10.6.7, 8, sorry, which will give you exemption with respect to ship, people who are traveling in ship, the workers especially. And then 10.6.11, which is applicable in case of training, people coming to India through foreign collaboration agreements, etc. They are coming to India. So there are also exemptions given there. And we have exemptions under 10.14. We have that exemption is basically any allowances paid for travel purpose. So there also some exemptions are available under income tax. And 10.10 CC, wherein Indian entity is bearing the taxes of the expatriates. Then the tax amount will be treated as non-monetary perquisite, and the tax on that would be exempt. So we have a couple of exemptions under Indian Income Tax Act. So let's see the provision under OECD. What should you do to avail the benefit under OECD? The OECD Article 15 says that subject to the provisions of Articles 16, 18 and 19, salaries, wages and other similar remuneration derived by a resident of a contracting state in respect of an employment shall be taxable only in that state. Okay, so in our example, we have a Korean person coming to India. Okay, so salaries, wages and other remuneration derived by a resident of a contracting state. Resident of a contracting state here is the Korean individual. He is resident of Korea. In respect of an employment shall be taxable only in Korea unless the employment is exercised. Okay, so it has been exercised as in he performs the duties of an employment in the other contracting state, that is India. If the employment is so exercised, such remuneration as is derived therefrom may be taxed in the other state. India can also have the right to tax. Okay, if it is exercised. Notwithstanding the provisions of paragraph 1, remuneration derived by a resident of contracting state in respect of employment exercised in the other contracting state shall be taxable only in the first mentioned state, that is Korea. If the recipient, that is the employee, is present in the other state for a period of periods not exceeding in aggregate 183 days in any 12-month period commencing or ending in the fiscal year concerned. Okay, he's there in the state for less than, in India for less than 23 days. And the condition is, and the remuneration is paid by or on behalf of an employer who is not a resident of the other state. The employer here is Korean company. They should not be resident in India. And the remuneration that is being paid by the Korean company is not borne by a permanent establishment which the employer has in the other state. So the Korean company should not have considered this remuneration as a deduction under the permanent establishment in India. If all the three conditions are satisfied, then the employee can take the provisions of Article 15 and then can go outside the purview of taxation. Okay, and with respect to ship, etc., the next provision is talking about that. So, notwithstanding the preceding provisions of this article, remuneration derived by a resident of a contracting state in respect of employment as a member of the regular complement of a ship or aircraft that is exercised abroad, a ship or aircraft operated in international traffic other than aboard a ship or aircraft operated solely within the other contracting state shall be taxable only in the first mention. Irrespective, if you are doing international traffic and then you are getting salary for that, then it will always be taxed in the country where the shipping company is located. It will never be taxed in the country where you might have rendered the service. Right? So this is what the OECD convention basically model convention basically talks about. To claim the benefit of OECD model convention, couple of things which are important. Okay, couple of things which are important. One, they use the word derived. Okay, they use the word derived. Why is the word derived very important? The thing is, when you say use the word derived, the word derived includes situation where you are paying in present, you are paying in future. It includes both the things. Right? So the remuneration derived from employment, thus taxation right continues even if received before or after the presence in source. So that is one thing we need to keep in mind. So this benefit under Article 15 is applicable or it can be used for money received before or after. For example, I am getting a signing bonus for coming to India. What happens because of that? I can get exemption under Article 15. Right? Then, if you are getting money as a director, as an artist, pension and government, and also student, professor, etc., you can't use Article 15. You have separate articles which is provided for you. This Article 15 can only be used by private sector employees. It can only be used by private sector employees. Then, here one of the important condition here is the employer should be non-resident in India. Okay, for getting the benefit here, employer should be non-resident. The discussion comes back to the same secondment in this one. Who is the real employer? That has to be answered. If the non-resident, in our example, the Korean company, if it is not the real employer, then you cannot take this benefit. You cannot take this benefit. So, to give an example, practically what happens is, let's say there is it's a person from USA. They have a subsidiary in India. Secondment happens. That person's employment is transferred from USA to India. When it is transferred to India, he is getting his salary is being paid by the Indian entity. He goes in, says that I want to take benefit under Article 15. the number of days stayed in India is less than 183 days in this year, this previous year. So I want to go and take the benefit under article this one. He will say that the money I am receiving is in USA, so I will take the benefit under article. The thing is, he is not eligible for this benefit because one of the conditions for article 15 is the employer paying the remuneration should be non-resident in the country of source, that is India. In this case, the real employer is the Indian entity, and because of that, he should be denied the benefit under article 15. Okay. So, who is the real employer is a very important aspect when we are going to give this benefit under article 15. So we have several case laws which explains what do you mean by employer-employee relationship when you treat a person as the real employer, etc. So in this case, wherein Supreme Court has held that direct control and supervision is very important for the purpose of employer-employee relationship. Okay. So, in addition to that, they say that degree of independence, degree of possibility, etc. All this also matters with respect to this relationship. So, the real economic employer has to be non-resident. That is one of the important. There are various case laws to support this. So let's take this situation. Let's see whether that person enjoys any benefit under Article 15. So in this case, Morgan Stanley, employee is of Morgan Stanley USA, was seconded to Indian company. Okay. And these employees perform stewardship role, as in managing role, on behalf of the US entity. And there were few employees who were providing services directly to Indian entity. Then what the Supreme Court observed was, even though it is a secondment contract, what happened practically was the seconded employees continue to be on the payroll of US entity. US entity was responsible for the work done by the seconded employees. The seconded employee continued to have lien over its employment with US entity. Any disciplinary action against seconded employees cannot be taken by the Indian entity without consent of the US entity. So these were the facts which was observed. These were the facts which were observed by the Supreme Court, and that's why in this case, the Supreme Court said that even though it was a secondment contract, technically the employer in this case was the US entity and not the Indian entity. So this is how employer-employee relationships have to be defined. Next, another important aspect to claim Article 15 benefit is where it has to be exercised in the source state. What do you mean by exercise in the source state? Right? So exercise in the source state means you should have performed the activity in the source state, and physical performance of activity is very, very important. Okay? So there are case laws to say that remuneration for period he visited home country for work related to host country employer is not taxable in India under Article 15(1). Okay, so let's say there is a German employee coming to India and he's being paid salary for services rendered in India. For a period of, let's say, 10 days or 15 days or 1 month, he goes back to Germany. Okay? And then he again comes back. For the gap period, for whatever period he is not there in India, can India tax the income? The answer is no. He cannot. He cannot be taxed for that income because the service is not rendered or it is not exercised in source state. It is exercised outside the source state. So India cannot tax that. So that is something which we have to keep in mind. Next, does the contract where it is entered, does it really matter? The answer is no. Because they use the word, it has to be exercised. The employment has to be exercised. Where the employment contract is signed is not relevant. Where it has been rendered or exercised, that is what is more important with respect to this. Then, allocable to permanent establishment. What do you mean by allocable to permanent establishment? Because under Article 15, if it is allocable to permanent establishment, that is the remuneration paid to the employee, if it is allocable to the permanent establishment, then you would not get benefit under Article 15. If it is not allocable to the permanent establishment, then you will get benefit under Article 15. The expression borne by in subclause C of Article 15 means deductible or liable to be deducted. Okay? So the permanent establishment in India, if it has used the salary paid to the non-resident for as a deduction when it is filing its return of income, then it is said to be allocable to him. If not, then it is not allocable to him. Okay, so that's the main understanding what we need to have under this. Next, we have so many circumstances under which non-residents are having income and they are getting taxed on gross basis. Right? We have turnkey power projects, or we have exploration of mineral oil. So if a non-resident is engaged in any of these activities, then this non-resident would be taxed on presumptive basis under 44 BB, BBB, all these sections. Okay. Now, when you say allocable to P, the question arose before the court was, in case the employer is doing presumptive return filing, does it automatically mean that it is allocable to P? Okay, so we'll take an example. So we have a contract. Korean company is a manufacturer of planting machinery. This Korean company has sold and it is engaged in turnkey power projects. Okay, so with the Bangalore Electricity Corporation, they have a turnkey power project wherein they will establish a power plant in India, and they also have other businesses in India. Okay. So the Korean company, for the turnkey power project, whatever it has done in India on behalf of BESCOM, it is filing, paying taxes under presumptive basis. It is filing taxes under presumptive basis. Parallelly, because of its association with Indian vendors and all those things, some people have come forward and they want to purchase some of the equipment from the Korean company directly. So they place an order on the Korean company, the machine comes to India. To assemble this, there are two people sent from Korea to India. Please keep in mind the machine which is coming and the turnkey power project what they have in India, both are not related. They are different. So the Korean company has physical presence, has a permanent establishment, and paying tax under presumptive basis for turnkey power project. Parallelly, they are sending equipment to someone else, and they are also sending few people to India for assembly. Now the question here is, two people who are coming to India, Korean residents coming to India, they are being paid salary. Can they take benefit under Article 15 is the question. The answer, we have to answer one by one. One, who is a person earning salary income? Two Korean residents. They are being paid salary by who? They are being paid salary by the Korean company. Now, the Korean company is filing taxes under presumptive basis. There are several case laws wherein the income tax officer has said that because the Korean company already is paying tax under presumptive basis, I am assuming that your salary is part of the presumptive turnkey power project, and then it is already included in the P&L account of the turnkey power project, and I am not going to give you benefit. Right? That's the argument by assessing officer. Courts have held that even though you have a turnkey power project which is coming under presumptive basis, it cannot be assumed that the services rendered by the employee are directly allocated to the entity that is a turnkey power project. It cannot be assumed, and that person will still be eligible for the benefit under Article 50. Right? So, just because you have a entity having this one, we cannot assume that it is related to that. Okay? So these are some of the aspects with respect to exemption. So when an expatriate is there, we have to explore section 1066, Article 15 especially, and understand whether the salary, whatever they are receiving, is taxable or not under these two provisions. Okay, once we find out residential place, etc., the next stage is that. Then, once we conclude that yes, salary is taxable in India, then what happens? We have different components being paid to the expatriates. Sometimes we have per diem, we have something called equalization pay, hypothetical taxes, social security and pension, and other certain benefits will be ESOP. So we have these elements coming into picture. How do we deal with these incomes? How do we tax these incomes under the income tax? Let's see that. When you have per diem, we have section 1014(1) read with rule 2BB, which gives certain exemptions. It says that if certain conditions are met, whatever per diem you have given to the employee, okay, which is received by the employee, expatriate, will not be taxable in India. Okay, how should that allowances be? How should that per diem should be? The allowance must be granted to meet expenses in performance of duties of an office. The allowances is granted to employee on tour or transfer. The allowances is granted to meet the ordinary daily charges. The said charges are incurred on account of absence from his normal place of duty, and exemption is available only to the extent with which the expenses are actually incurred. Okay, so 90% of the cases, what happens is, if an Indian person, Indian company is sending someone for on-site work, per diem will be paid, and that is when this section comes into picture, and That is when the employee has to use this section to claim exemption, from taxation on the per diem what he is receiving. Okay. So, should the employer check invoice by invoice before he grants the exemption under 1014(1), or is it the responsibility of the employee to take care of this provision? Okay. So, in the case in decided case laws, evidence of related to expenditure, it is upon the employee to make sure that whatever money he is received as per diem, he has spent it and he is able to claim the benefit. If he is unable to spend it, he needs to inform the employer to say that this has to be taxable, you have to tax this. Okay. So before you give the benefit under this section, you need to make sure that you have some kind of declaration from the employee to say that he has spent the per diem money which has been given to him. Then, sometimes instead of per diem, we do actual reimbursement. So, if you do actual reimbursement, is it taxable? Answer is no. So, if you do actual reimbursements, there is no question of allowance as such. It is basically cost to cost reimbursement. So, that will be outside the purview of tax. So, expenses given as reimbursement of money which would be required by the expatriate to spend for his stay in India rather than personal advantage was not a perquisite within the meaning of section so and so, and or salary within, so it would not be taxed. So reimbursement, if it is given, then it is taxable. Then in case of this ARR this one, they also explain that allowances given in terms of living expenses, furnished house, airfare, per diem for rest period, home travel, car, etc. are exempt under 1014(1) in the hands of the foreign deputies. Okay, so that is something which you need to keep in mind. So whenever there is a deputation by the foreign entity, and they are paying certain benefits to the employees, all these will be exempt. Airfare, etc. will always be exempt in the hands of the employer. Then equalization, tax equalization. What do you mean by tax equalization? Now I am working, let's say in Germany, my tax rate is 25%. I come to India, my tax rate goes up to 35%. So 25% minus 35%, additional 10% deduction is incurred. Right? So this is something which I will say that why should I do that? I am not an employee for you. It is your responsibility to take care of all those things. So we do something called tax equalization in this case. So let's take example. So salary is 1 lakh. Okay, in home country 1 lakh. And the tax rate there is 35%. So tax payable in home country is 35,000. Net payable to him is 65,000. Now, if the assignment is to the host country, that is India, let's assume, without equalization, 1 lakh will be there, and tax in the host country, that is India, will be 40,000, and home country, it is because he is resident of that country, so global income is taxable. There will be 35,000, but he will get foreign tax credit. Because he will get foreign tax credit, the 35,000 will be deducted, and balance in his hand it will be 60,000. What will be payable to him? So 5,000 rupees is the loss what he is incurring. So he is saying that you have to pay me 5,000. If I have to pay him 5,000, I need to keep in mind that on that 5,000 whatever I give him, there will be other tax. It will subject to be another tax. So you need to make sure that you gross up the difference whatever you give to him. So the 5,000 whatever you have to pay him for the difference in the net pay would be grossed up. It would be grossed up in a manner wherein 5,000 multiplied by 100 and divided by 60, because 60 being the Indian tax rate. So it would be 8,333. So that will be added to 1 lakh, and that would become the tax which has to pay in India. So in this case, the tax is borne by employee. It is not borne by the company. Whatever the difference in tax rate is there, that is what is borne by the company. Okay. So the expat itself, he has to take care of this filings in this case. Then we have something called hypothetical tax. What do you mean by hypothetical taxes? In this case, the employer himself will take care of the taxes for the employee. But the way he will take care of the taxes is, now you are, let's say, a German person, your tax rate is 35%, you are getting transferred to India, tax rate is 45%. German company will say, I will bear the taxes. Now, when they say they will bear the taxes, will they pay the tax at 45%? The answer is no. What they will do here is, whatever the 35% tax, what is there in Germany, they will deduct it from the salary itself. So he will be, we will deduct it from salary and we will keep it aside. And he will be paid salary in India, and whatever the taxes which comes on that, that will be paid by us. We already have deducted 35,000. We already bear 45% for him. So the difference between that will be the adjustment to the employee's salary. Okay. So we will see how it works. So the employee deducts the tax on the employee's home country's salary as per the home country's tax structure. This is called hypothetical tax. Hypothetical tax is not an actual tax. The question here is, when I deduct the hypothetical tax, when I go for let's say income computation, should I consider the hypothetical tax as deduction from salary and calculate his income chargeable to tax, or I should not give the deduction to him? That is the question. Okay. So in this case, with hypothetical, without hypothetical tax, in home country he is getting 1 lakh. Hypothetical tax in the home country is 25,000. So I deduct it upfront and keep it aside. 75,000 is his salary under hypothetical tax. Under regular situation, it is 1 lakh, because I don't do any hypothetical tax deduction. Then, because he's being assigned to India, he gets 25,000 additional allowance. So 25,000, 25,000, both are given. Salary to him is 1 lakh under hypothetical tax situation, 1.25 lakhs under without hypothetical tax. Then the host country incremental tax is 7,140. That is the additional tax. That is additional tax, 5% difference between the 25,000, 25% and 30%. The difference on that income is what I have to pay. That is similar to equalization. So I pay that. The total taxable income will be 1,07,143, and hypothetical in this situation it will be 1,25,000. The tax in the host country, that is India, will be at 30%, 32,143, and here it will be 37,000. This 32,143 will be borne by India. It will be borne by the employer. So what they will do is 25,000 they have already deducted, and 32,000 is what they are paying. So the difference amount, whatever is there, that they will basically collect it from the employer. Okay. So this is how hypothetical situation works. The whatever taxes are there in the home country, that deduction of that in the first instance, that is the main difference as compared to equalization. In equalization, you only adjust a net pay, but in this case, you bear the whole taxes. So that's the main difference between equalization pay and hypothetical tax. Now the question here is, once you deduct 25,000 from this one, whether the income chargeable to tax under income from salaries, is it 1 lakh or 75,000? Okay, so various case laws are held that this hypothetical tax, which has been reduced from salary, does not constitute income in the hands of expatriate, and therefore cannot be treated as part of employee's taxable salary. Okay, so that 25,000 deduction will not be treated as income, and it will be what challenges you can face is, in case you have to deposit PF for that person, because he will become an international worker in India, you have to deposit PF for him. Whether his salary is 1 lakh or his salary is 75,000, that will be the practical challenge. I personally suggest 75,000 should be the income in his hands, even for those provisions also. And when it comes to the taxes which we are incurring on his behalf, it is treated on par with non-monetary perquisites, and then you don't have to gross up the salary, the tax what you are bearing on his behalf. So 1010cc, which provides that amounts paid directly by the foreign employer to discharge employees' income tax liabilities exempt in the hands of assessee under section so and so. Only thing is, the person who is bearing the taxes, he will not get deduction under 40A. That is something which we need to keep in mind. Then, social security benefits. So we have seen allowances, we have seen equalization tax, we have seen hypothetical tax. Next, PF. Is PF applicable on international workers? Answer is yes. Okay. So what happens here is, in case of a secondment, the employer stops the employee for the non-expatriate will stop in foreign entity, and he will become employee of the Indian state. So when this happens, when the employment changes, two aspects will be there. One, what happens to the benefits which he has accrued so far under his earlier employment? What happens to his benefits with the new employment? And once he exits from the Indian entity and goes back to his home country, what happens to his accrual? And what happens to his accrual? He may have contributed to pension and all those things. What happens to that? That is a very big matter, I would say it's a very big cost for the company. Under Indian context, PF is applicable even for an international worker. Okay, so who is an international worker for PF? A foreign national working in India for an establishment covered under EPF Act. Okay, would have to get covered under these benefits. So the PF Act will apply to expats working for an Indian employer to which EPF applies. Right? So in this case, that person comes into India and then we have to contribute. When we have to contribute, we don't have the benefit of 15,000 limit, etc. We have to contribute on actual basis. So to avoid this double contribution of benefits, India has entered into something called social security agreements with different countries. Right? We have with Japan, we have with Germany and all these places. If you are coming from a country where you have social security agreement, then you have to bring something called as certificate of coverage. You have to bring something called as certificate of coverage from that country. Once you bring that certificate of coverage, what happens is the international worker can declare to the PF authority saying that, see, whatever contributions are there, it will continue in my home country. Do not apply the provisions to me in India. Option 1. If he continues to be employee for I think generally 5 years only. If it continues beyond 5 years, then PF will be applicable to him and then deduction will happen under PF. And then when he exits India, he can take whatever the deductions which have happened, he can take back to his, so Indian PF authority will transfer the funds directly to the contribution in the foreign jurisdiction. That is the benefit of having social security agreement. Okay, so those are some of the things which we need to keep in. Then what happens sometimes practically is mandatory contributions will be there. Indian employees, let's say they are sending someone abroad on deputation, they are going outside India. Under certain European certain European countries, you need to contribute certain percentage of salary compulsorily to this one. These are mainly for health benefits. Okay, these so whenever an employee is getting deputed there, they can use the health facility in that country, but provided the employer has to deposit that money into the contribution of the government. Now the question here is whether this deduction from employee's salary towards certain contributions, when we are filing for taxes in India, can we claim deduction of that or not? Or we don't have any provision for that? That is the question. Here, these are not the benefits which can be taken back. These are benefits which once contributed, you will never get refund of that. Okay, so these are mandatory contribution. So, in this case, there are case laws which say that the employees can claim the amount as deductible and the contributions are not taxable. Okay, so these, whatever deductions happen, the employees can claim deduction and you need not pay tax on that. If you are voluntarily contributing to certain schemes, okay, if you are voluntarily contributing to certain schemes, generally case laws have said that it is not deductible, you have to pay tax on that. But if you have mandatory deductions, especially which will not be refunded back, you have it in Switzerland and all those places where they will, you need to contribute for their medical facility, they will not give the money back, you can take deduction of these things. Right? So, when you have to take deductions, what are the case laws trying to say in these cases? One, the contribution should be compulsory or mandatory in nature. The employer should be authorized to deduct the social security contribution from monthly remuneration payable to the employee. Certain penal implications are there for default. No vested right conferred on the employee. Contributions are required to be made by all employees compulsorily. Overriding title on income from remuneration. It should not be a company framed scheme. Guarantee the workers and their families against all types of risks susceptible to reducing the earning power. Home country income tax laws allows for full deduction of social security contribution and only net income is subjected to tax. So, if these principles are there, even though Income Tax Act doesn't provide for taking deductions of these contributions, case laws are held that because these employees are contributing in foreign locations, income is taxable in India, you are going for filing your return of income in India, and they have not got the income, it is because it is contributed through because of compulsory contribution. You can take deductions for these contributions by the employee. Okay. Then we have case laws which say that payment of medical insurance by employer for the expat employee is not perquisite because compulsory. Payment by employer of tax consulting fees for filing expats returns is also not perquisite, as tax was to be borne by the employer. The tax refund received by expat employees are not income in his hands, as tax was borne by employer, and thus the refund was loaned to employee. So these are some of the findings of court with respect to such contributions and such contributions made in case of employees. Then ESOP. So when it comes to ESOP, what happens in case of ESOP is you have an employee and then he is working in foreign jurisdiction, he comes to India. The period of service continues for the purpose of ESOP. Okay? And in this case, when he is in India, the vesting happens or the allotment happens. Then how does the taxation work in this case? Right? So in this case, the taxation has to be apportioned, has to be proportionately calculated, and it has to be offered to tax. We cannot offer 100% of the ESOP value to tax in India. Okay, that is something which we need to keep in mind. Then, in this case, proportionate value of ESOP continues to remain taxable in the country of employment, even if the employee has shifted to another country and so and so. So these are some of the provisions with respect to employee benefits. Next, withholding of taxes and other issues. So withholding of taxes is very important, because if you don't withhold, you become assessee in default, there can be prosecution, etc., etc., and whatever expenses if you are bearing, it will not be allowed as deduction. So who is required to withhold taxes? When it comes to withholding of taxes, the employer, the real economic employer, is the person who has to withhold. Where it is paid is not important. It is the real economic employer is the person who is required to withhold. Okay, so is tax required to be deducted at source from salaries of expatriate working in India, even in case where the such salaries are paid abroad? The answer is yes. So if you are the real economic employer, even though you might have paid abroad, you have to pay the TDS on such. Then, can the withholding taxes be higher than the amount which is due? Okay, so sometimes they don't give. We are paying salaries for expatriates without giving any deductions, without giving VWA benefit. Can we calculate and then remit the taxes? The answer is no. Similar to Indian employees, where we calculate by including all his income and then giving benefits, deductions, etc. How we calculate, the same thing applies even to a non-resident also. We have to calculate his salary similar to Indian extent, and then we have to do the TDS. Then, in case we have not deducted, but the employee files his return of income and then he deposits the applicable taxes, can we be saved from that situation? The answer is yes. So can interest and penalty be levied on employer who fails to deduct tax at source if the employee has paid tax by way of advance tax or self-assessment tax? So if all the conditions of Proviso 201 are satisfied, no interest or penalty are leviable. Okay, so if they have done the duty, then you can be absolved of your responsibilities. But you have to prove that they have done the duty. Then, we already discussed this. Our reimbursement of expatriate salary is in the nature of FTS. The moot question here is, when you are reimbursing salary to the foreign entity, the reimbursement is equal to the employee salary paid to the employee. The FTS or not would solely depend on the question whether the who is the economic employer. If I am the economic employer, then I need not treat the reimbursement as FTS. It is a pure reimbursement. There is no TDS required to be deducted in this case. Okay. So, but the facts are very important. Practically, they say it is secondment, but there will be deputation. Sometimes they use the word deputation, there will be secondment. So there is a cross, even though the word means the secondment is transfer of employment. Practically doesn't happen sometimes. So you have to be careful practically. Then we have so many cases where we have Indian employees, they are working for the subsidiaries, but the holding company is issuing its listed shares as ESOPs to Indian employees. In this case, who has to deduct TDS? Should the Indian company deduct TDS, which is not at all issuing the ESOPs? It is the holding companies which is issuing ESOP to the Indian subsidiary employees. Who has to deduct TDS? It will be the payer. The payer will be here technically foreign entity which has to deduct the TDS. It has to take PAN number and then do it. But practically it is not possible. So government is okay with Indian subsidiaries deducting the withholding of taxes on behalf of the foreign entity. There are case laws to support this. Then when you are doing the TDS withholding for expatriates, can you take the benefit of DDAA? The answer is yes, you can take the benefit. But one thing you have to be careful is their tax residency certificates, Form 10F, and their declarations have to be taken. You cannot give them the benefit under DDAA unless their tax residential status has been proven through some authenticated document, right? So, if you are giving benefit under DDAA, Article 15, you are giving benefit to that employee, even though you are paying salary, you have to make sure that TRC is there. And as soon as TRC is there, you need to have Form 10F. If you don't have Form 10F, then when you file the return, it will be treated as defective return. So you need to have Form 10F. And it's also suggested you need to take self-declaration that they intend to take the benefit under DDAA. When you're calculating salary of expatriates, should you consider the foreign tax credit if they have paid somewhere in some other country, wherever they are? Should you consider? The answer is yes. Similar to foreign tax credit is very similar to your TDS, so you have to take the deductions under when you are calculating your TDS under first, especially for salaries. Then Form 67. Filing Form 67 is very important. Filing Form 67 is very important. Wherever you are filing the return of income for an expatriate, you are taking any benefit under DDAA, you need to ensure that, or FTC, you need to ensure that Form 67 has been filed. The due date to file Form 67 has changed. Earlier it was along with the return of income. Now it can be at the end of the assessment year also. Can be at the end of the assessment year also. Okay. So that is something which you need to keep in mind. The reason why it is shifted to end of the assessment year is because sometimes the non-residents may means the residents who have income abroad, they may need more time to pay the taxes in those countries and then take the credit. So that's the reason why they have shifted it to end of the assessment year. Then currency conversion. There are situations where expatriates who have received money abroad, but they are liable for taxes in India. You need to convert that into INR to calculate the TDS. Right? There will be situations where residents will be there, they would have paid taxes abroad for which you need to take foreign tax credit. How do you convert either the income or the foreign tax credit into INR to calculate the FTC or FTC or income for the purpose of taxation? For that you need to refer to Rule 26 and Rule 115. Rule 26 says that if a person who is liable to tax in India, he is receiving some money in foreign currency on which TDS is deductible. Then Rule 26 will apply and the currency conversion will happen based on SBI by TT. It will happen on SBI by TT on the date on which TDS was required to be deducted. If it is non-TDS cases, then it will be Rule 115. Wherein the SBI by TT, especially for salary, will be the by TT the preceding to the month in which your salary is basically due. And when you talk about FTC, foreign tax credit, how you convert that into INR? So that is also converted based on telegraphic transfer buying rate SBI based on the month immediately preceding the month in which tax has been paid or deducted. So that's how you convert the foreign currency into INR for the purpose of calculation. Next, some of the procedural requirements when it comes to expatriates. One, should you take PAN? The answer is yes. You should take PAN because PAN is required wherever TDS is applicable. So, if TDS is applicable, you should take PAN. Return filing. So, you have to file a return for expatriates. Okay. So, that because you are taking benefit under DAA or some exemptions, whatever is there, generally you have to file the return of income for expatriates. When a foreigner comes into India and then he stays for 180 days or more, then he needs to register himself with something called as Foreigners Regional Registration Office. That also you need to keep in mind. That is the same office through which you can extend your visa, etc. So, but you need to register yourself with that office whenever that person comes into. Then, because of let's say DDAA, in certain salary is not taxable. So, can you do away with not filing return of income? The answer is no. Courts have held that if you are taking benefit under DAA, you are taking benefit under Section 10, you need to file the return of income in India and then claim the benefit. Then, if the person is going outside India, means he is returning back to his home country, are there any compliances which have to be done? Answer is yes. Section 230 has NOC which has to be provided. So, if it is inbound expats not domiciled in India or leaving India, every person who is not domiciled in India and who has come to India in connection with business, profession, and employment is required to obtain NOC in Form 30B from tax authorities before departing from India. Okay. If you are employed, then what happens is Form 30A expats will have to furnish undertaking obtained from the employer that they will take care of the taxes in Form 30A. If your outbound expats, that is Indian people going outside, Indian domiciled individuals leaving India must furnish Form 30C with prescribed particulars to and obtain NOC that all taxes due are been paid. If you don't have PAN, you have Form 31. Then, Schedule FA. So, whenever you have expatriates who become resident and ordinary residents, okay, generally 3 years or more than 3 years, if a person is there in India, they will become ordinary resident. You need to make sure that you declare their foreign assets when you file the return of income in India. Right? So, the Schedule FA is applicable even for foreign citizens also. So, you have foreign bank account, depository, interest, etc. All these would be required to be disclosed. Then, you have new scheme of taxation which has come into picture. So, here by default it is new scheme unless you opt out. And when you have salary, you can salary income you can opt in or opt out in every year depending on this one. You need to file certain form to opt out. So those provisions are applicable even for non-resident individuals also. The surcharge rate is also limited on certain types of income. That is also you need to keep in mind. Margin relief is applicable, but only thing is the non-resident individual are not eligible for 87A relief. Okay, non-resident individuals are not eligible for 87A. The tax rates are this. Then, foreign exchange regulations. Right? FEMA also plays a very important role when it comes to expatriates. The problem is when an expatriate is not citizen, he comes to India under FEMA. Because of his stay, etc., he will become resident. But he says that I want to receive money outside India. So there is a situation where there is a resident under FEMA working in India. He is getting salary paid outside India. Is it allowed under FEMA? Answer is yes. So FEMA has given certain exemptions, especially for these sort of people. So a foreign national resident in India is permitted to receive his entire or part of salary outside India only if he has been sent under a deputation arrangement, and the deputation is to subsidiary, joint venture, office of foreign company in India, and taxes are paid in India on entire salary. Now this has been further extended to cover employees of foreign company or LLP on deputation to group companies also. Before it was only subsidiary, joint venture. Now it is group companies also. And he is employed directly with an Indian company, that is also covered. So, if other than this circumstance you are paying foreign exchange outside India, then you need to take specific permission from RBI. Okay, that is something which you need to keep in mind. Then, if you are a Indian citizen who is born abroad and then you have this one, you need to convert your regular account into NRO. You need to deposit into that account if you are paying salary in that, and then he can take it outside India. He has certain limits. 1 million, he can take money outside India, 1 million. Okay. So these are some of the provisions applicable to expatriates. Any doubt? Please let me know.
That DTA, foreign tax credit, suppose that returns will be a calendar year. How to take that proportionate 9 months, 3 months?
So it is called as a split residency. What happens here is, we take an example from 1st of January 2024 to 31st of December 24, he is a resident in USA. 1st of April 2024 to 31st March 2025 is a resident in India. So there is a overlap. From 1st of January to 31st of March, no problem. His global income is taxable in USA, no problem. Between 1st of April to 31st of December, he is resident of USA, he is resident of India. First, you go to DTAA, break the tie. Once you break the tie, let's say he becomes resident of India or he becomes resident of USA. Let's assume he becomes resident of India. Then from 1st of April to 31st of December, he will be resident in India, global income is taxable in India. In USA, you have to make sure that you have to, you should take, if any DAA exemptions are available, you have to take that because you are a non-resident in USA. From 1st of January to 25 to 31st of March 25, you are resident in India, global income is taxable, no problem.
So one more question. A person for the previous year 24-25, he would become a non-resident because he is, not stayed in India for 182 days, less than 182 days, and he has left for the purpose of employment. So he's gone to the foreign company. He was working in a subsidiary of foreign company in India. So uske baad he has gone to the holding company in the United States. So the company in March 2025, they have declared a bonus of 1 crore. Indian company, because he served in India for 4 months, so for that service purpose they have declared. But by the time he received the bonus, he will already be working for the holding company in the United States. So in option A, if the amount is of 1 crore is paid in Indian rupees and is a part of Form 16, what is the taxability in India and US filing returns? And secondly, if they have declared the bonus and they pay to him in US dollars, that time what will be the taxability in India and US for 24-25?
Currency conversion will ignore for that moment. Whether you pay it in Indian rupees or whether you pay in US dollars doesn't matter. Where does it accrue? For service rendered in India, so it will become taxable in India. So in that bonus portion, whatever is there, it will become taxable in India. India has the complete right to tax it for that period. So he has to pay taxes on India. In case he goes to USA and USA technically can't tax this.
But he has to show that in US also because it's a global income. He has to while filing his returns in the United States.
So for that, what happens is from first of for that period for which the bonus is paid, for that period he was not there in US at all. So because of the calendar year concept, he may become resident in USA because of the calendar year. In that case, what happens is that this residential status has to be split based on the period, and then for that period where he was resident, do the tiebreaker and apply the provision. So US doesn't get the right to tax global income for that period in this case.
I have an Indian SSC, all these Microsoft, Intel, those kind of employees. They get foreign dividends for their resource. I have notices where my dividend from these resource was added at to 30%, and we have an Article 13 of PTA where we have 25% accurate. Where am I wrong?
So these dividends, whatever you are receiving for the ESOPs, right? How was that? So your holding is there. When you held those ESOPs, were you resident or not?
All these people are resident in Bangalore.
So if you are resident at the time you held these securities and the dividend was declared, means you need to see the taxability of dividend. Okay, dividend is taxable on declaration or this one. So at the time of declaration, if they were resident in India, then the global income is taxable in India. So in USA, they need to take the benefit under DAA and you need to tell them to apply the TRC in India and then give it to them. They will deduct at a 25%. In India, you get credit for that.
We have a 1042S, I'm so sorry. So for 1042S, the credit was given, but I ended up having for that differential a tax liability.
So the thing here is you're saying that they have deducted the taxes and you have the proof of that.
Yes, I
And in the Indian return, what did you do? You filed the Form 67 and
Form
gave the credit.
67 has been filed for the foreign whatever equivalent converted tax which was deducted in the US.
And then they have denied the foreign tax credit.
Sorry?
They have denied the foreign tax credit.
They gave us a foreign tax credit, but the dividend was taken at 30%, and it's a very elaborate.
Yeah. So the rate of tax is, so once you are a resident in India, once you become a resident in India, your global income is taxable. If you refer to the DDAA, under which you are saying 25%, they could say that the ultimate right to tax dividend income rests with the home country. Source country, which is USA, can tax it, but they can limit it only to 25% or 15%, whatever it is. So the tax rate, what you are referring to, is applicable in USA. It is not applicable in India. What the AO has done is correct, because once you are resident, global income at slab rates is taxable.
Even when you are not through ESOP, if you are holding the share stocks, foreign stock, same here.
Same. It's
In continuation to that, if section 90 says whichever is more beneficial, how do we interpret
Yeah,
that?
that's what.
whichever is.
Section 90 says whichever is more beneficial for the SSC. So how do we
Actually,
interpret
if you refer to the DDAA, the DDAA says that it is dividend is taxable in the country of home. Country of source has the right to tax, provided it is limited to 10% or 15%. Whichever is beneficial will apply to the country of source, not the country of home. We are country of home in this example.
And conflict in the US will be less. They will accept the filings.
We have to take TRC from Indian tax authorities, then we have to submit it to them, we have to ask them to deduct at DDAA rates, which will be lower in USA.
I think this problem is like it's common for many people, because when we try to file for a person holding a foreign ESOP and
Having foreign dividend, when we try to file during validation, we get a suggestion or error, if I can call that. If we show that foreign dividend in the normal dividend column, utility will not accept. It will say show it under dividend under special rates on that.
Yeah.
So it will take it at 25%, credit also given at 25%. Later AO will say no, dividend is at 30%, as you said, which is correct. So but while filing, utility only will suggest us to show it under a column under dividend under special rates. So that's the issue that is happening.
I don't believe that, because as per the tax laws, it has to be taxed at highest slab rate. I don't know if I could have shown our this one. I will show you. It is possible. We have taken it at that rate.
So it would be more appropriate to now show like all Indian companies got full rate at 30%, and we ignore APA
Yeah.
and in that line. It is
Yeah.
irrelevant.
I think you still have to, for the FTC claiming, you have to still show it, this one. But taxable at Indian rate would be at your slab rate. You need to calculate the average rate and then offer at higher rate. This you have to offer at, you have to show it at, deducted at lower rate.
So my question to you is on this concept of global employer of records, which is actually gaining traction these days as a lot of entities having global presence. They prefer to hire global talent without setting up local entities. So in the context of expatriate taxation, I just wanted you to throw light on how the use of global employer of records actually impacts, the taxation. It could be the residential status, the source of income, foreign tax credit, and so on. Because it's not a very common thing that we hear here in the Indian context, but I have come across clients who are exploring this option.
Okay. First one is you have a global you have a company, let's say in USA, they want to have a person in India. He's a very talented person, they want to have a person in India. The first question is, do you want to have him as an employee or do you want to have him as a consultant? What do you prefer? No, you tell me, what do you prefer?
The scenario that we came across is the company is actually based in US, and of course they're having global presence. They function in several other countries, and especially when we speak of Section 8 companies, because of the FCRA regulations which restrict the amount that you can pay, say the CEO of the company is really devoting a lot of time, to achieve the objectives of the company, they have preferred this route. They have, preferred to opt in for this GEOR to hire people. And to answer your question, I think it was the consultant.
These people call it as consultant, but in reality they would be employees. Then
yes.
They would be working only for example, if I am advising, let's say, that entity in USA, I am not an employee. Because I have clients in Bangalore, I have clients somewhere else, I am doing, even though I will be doing, let's say, bookkeeping or something.
Yeah.
But if you are solely working for them, even though you are paid as a consultant, technically you will become an employee. Once you become an employee, what happens is, for the US company, you become the presence in India. Once you become the presence in India, through you, some business transaction happens. There is an element of permanent establishment risk for the US entity.
Yeah.
The US entity will have permanent establishment risk, and let's say because of you, they won a contract of $5,000, 5,000 crores. That 5,000 crores is income chargeable to tax in India. That is one aspect. The money, whatever has been paid to that person, those people have to deposit TDS in India, because he is an employee, and then that money, whatever being paid, is salary. So they need to do TDS compliance in India for that person.
So we saw that the GEOR was actually registered in Singapore, but the entity which is hiring the GEOR and asking them to facilitate this whole process is based in US, but the operations are actually in India, and the GEOR is entering into an employee-employee agreement with these people.
You can do whatever you want on paper, but if the tax department gets to know this, then they would certainly have. Majority of the cases, in these cases, what happens is they do a search, survey operation, and once they do search and survey operation, that is when they come to know these things exist, and that is when the whole thing starts. Now, who will they catch? Will they go and catch a person in USA? No, the answer is they will go and catch the person who is there in India. They will treat him as an agent of the non-resident, and whatever the taxes which are due on that, let's say 5,000 crores transaction, they will try to collect it through him, and they will tell that you go and collect it from them if you want at your own rate.
Only limited extent marketing survey. If it is appointed, then it is allowed.
Marketing?
If it is only marketing survey kind of a concept.
Wherein you are not.
That is an exception.
You are not concluding the transaction. You are just promoting something. If you are paid at arm's length, yes, no
Just
problem.
to make the survey.
Yeah.
Like Tesla, will it work or not work? So then that is not covered as a P.
That's a license office. Yes.
Yeah, license office. So what we say is license office, then P. Next.
That doesn't result in P. Yes. If you are a license office collecting information.
Yeah.
Thank you.
Good evening, Namaste members. I would like to express my heartfelt gratitude to all the esteemed members present here for today's session. Thank you, sir, for this insightful session on the expatriate taxation and foreign tax credit. A special thank to our speaker, C. Abhishek Murthy sir, for sharing his valuable knowledge and expertise on this important subject. Now I would like to request C.M. Manjunath Allur, Chairman of Bangalore Branch, to present a memento to our speaker on behalf of Bangalore Branch and the member present here. Thank you, Chairman sir. Thank you once again, and let us carry forward the knowledge we gained today. One more announcement: tomorrow we have MSME seminar from 5 p.m. onward at the branch. Kindly register for the same. Thank you.